There are three major mistakes that investors make. In today's video, we're going to tell you how to avoid them. In today's episode of Ask TMFG, we're going to walk through the three major mistakes that investors make. We're starting to see this pretty frequently, even just scrolling online and seeing other people's opinions through Reddit, through YouTube, for what have you. It's common mistakes that people make. And Carlo, why don't you get us started with them?
Absolutely. Everybody, when you're scrolling, everybody on Instagram, TikTok, whoever has an account is a financial professional.
Correct.
That's just not the case. And a lot of the advice that you're getting is totally wrong, or it's playing on your emotion. You can get rich quick, be a guru when it comes to finances. The amount of times I've had people come into my office and tell them that they know somebody who's a guru. I'd be a millionaire now and I wouldn't have to be working and doing these videos with John.
Yeah.
But what we're finding though is that there is a common theme. And one of the themes that we see is people on TikTok or Instagram are telling investors that individual stock picking works as long as you're putting in the effort, as long as you're putting in the time to go through financial statements and make the right decision at the right time. But I think we all know that just doesn't happen frequently.
Yeah, that's a great point. And I get why people can get confused or misled in that because with a lot of other things in life, the more effort you put in, the more you're going to get out of it. We hear that pretty frequently. Just the unfortunate thing is when it comes to investing, that doesn't quite work the same. Markets are entirely efficient. When a stock is priced a certain way, it's because all public available information is going into that stock price. There's nothing that you can figure out that's not already public information that's going to give you an upper hand. And you may run into a situation where you pick a good stock at a good time and you make money, but that stock was openly available to anybody to purchase at any point, right? So this is kind of just the way it is, where you're not going to figure something out that the rest of the world doesn't, and if you do, it's probably insider trading, and you shouldn't know that stuff.
I was just about to mention that. That's why there are insider trading rules that we should be avoiding, because if you are an insider, then you have information that the general public doesn't know, and you put yourself at an advantage than the general marketplace. And that's why the market works, because everybody has access to that information, and that's what prices stocks appropriately.
Yeah.
It's funny. There's a statement that Rob and Mike like to use, and we've done it in several videos or seminars where they talk about a bar of soap.
Yes.
And like everybody out there knows, a bar of soap, the more you touch it, it gets smaller and smaller. And they liken that to your portfolio. The more you tinker with it, the more trades you make, the more worry that you put into it, it's just going to get smaller and smaller, the opposite of what you want your portfolio to do.
Absolutely. Absolutely. And it's one of those things where, it's very difficult for people just to kind of sit back and let the markets work for you. When something feels broken, our natural instinct is to get in there and fix it. The market's a living and breathing organism. It'll fix itself. It'll solve it. It may take time, and that's where people become impatient and don't want to wait that degree of time or think there might be an opportunity there. But patience really is a big part of what a successful investor is.
But in other cases, in other things in life, the more effort you put into things, typically the results are good. I mean, you want to do well on a test, you study harder and you get the information, and typically your results will be better. If you want to be a better chef, you put more effort into the recipes, you make more meals, and you create a better dish.
You aren't a very good chef, are you?
Not necessarily. Not necessarily. You can ask my wife. She can testify.
Yeah. And that actually brings us to our second point, lying to yourself. We've had this happen to, in our experience of dealing with clients all the time, where it's, I'll save later, or, I'll be ready to do this down the road. I'm just not yet. I'm not quite there yet. And we see it often, specifically in regards to saving, where we always have that conversation. Carlo, you've mentioned it a million times. Pay yourself first. That's the one thing that we want to prioritize. Oftentimes we are lying to ourselves and saying that'll be something we can address down the road. We'll solve this issue later, because change, or even saving in general, the discipline that goes into it, is not something people want to deal with.
Absolutely. It's instant gratification. We want something immediately. We don't want to delay that gratification. So yeah, I'll invest later. When later comes,
Yeah.
it's now. And so you're just going to continue to kick that can down the road. But what I also find to be an issue is ego. Ego gets in the way.
Yeah.
You know, I can outperform the market. If I just put more effort into the portfolio, I can do better. That's why these do-it-yourself portfolio platforms exist. For people who want to satisfy that craving or think that they can outperform the market. Everybody's, like I said, on Instagram or TikTok is a portfolio manager or an expert. Even the professionals, institutional money management, portfolio managers, they can't outperform the market even with a number of people on their teams. Yeah. So I don't know why people have the ego and think that they can outperform the market when professionals can't.
Yeah, exactly. It's incredibly difficult, and it's a degree of difficulty that's in a lot that's outside of your control, right? And we often have that conversation.
Right.
Control what you can, whereas when you're dealing with investing, you're kind of at the hands or the mercy of what that CEO or that board of directors is doing for that company. And that's actually the third point. It's often thinking, well, Apple's a great company, so I should just put my money in Apple. They surely can't do bad in a given year. Where recently, you're probably pretty right. Apple's done amazing. But we've seen it firsthand that there are some major companies that even though they are successful, even though they are profitable, do have those bad periods. So if you are, again, trying to be this portfolio manager and try to predict who's going to outperform, just because the past 10 years worth of winners doesn't mean they're going to be the next best winners in the next 10 years, right? Past performance doesn't lead to future performance. And this is where a lot of people run into trouble with that.
Yeah, the data is there. People who manage stocks on their own, portfolio managers, they can't outperform the market over a long period of time consistently. You might find the stars that can do it for 1 or 2 years, and that's great. But our issue is, how do you find those winners? If you are a retail investor, are you picking the right stocks, the right great companies? Great companies can have quarter after quarter record-breaking revenue, but it doesn't necessarily mean that the next quarter, the next year, the next fiscal year, they're going to have a record-breaking quarter. And typically when you find companies that provide great performance, that's really hard to maintain.
Yeah.
And whether it's change in management at the company or economic factors that are impacting that specific industry, that growth isn't going to happen consistently over the long term.
Yeah, and we go back to it, own the entire marketplace. My perfect example is in our portfolio, we hold NVIDIA. NVIDIA has been a great company, and it's grown in value astronomically in the past couple of years. We held NVIDIA when it was a tiny fraction of a percent, and now it's grown to this monster. Now's not the time you want to be buying into it. You probably want to hold it while it's at a small point. So if you're just globally diversified, you're going to capture all those winners. You're going to see them from a small part of your holding to a bigger part of your holding just through diversification alone. And it's not so much about being afraid of purchasing some losers. There's going to be losers in there as well, but it's the major market winners that really drive the entire economy. And as long as you're buying everything, you're guaranteed to be investing in those. And therefore, you're guaranteed to get a pretty good rate of return. That's all you want at the end of the day.
The investing industry is funny. It's the only place that I see people running to the front of the line to pay more for a specific thing. So what makes a good company? Typically when returns go up and you see the share price go up. That means you're paying a higher price to own a piece of this company, but people want to do it. And what we found is when markets get high or companies get high, they don't want to invest. But when is the best time to invest?
Markets are down.
When markets are down. But you get those same people seeing the market down and think, well, I'm afraid to buy when things are cheap as well.
Yeah.
So when is the right time to invest? Take that completely out of the formula and just invest when you have the money, you have a portfolio that you want to invest in that makes sense for your situation, and leave it. Don't play with the portfolio. Don't play with that soap and shrink it. Stay invested in the market. Don't make those changes that could just essentially impact your long-term return.
Yeah, and this is just a pretty good summary of when clients ask us, why do we need to work with a financial planner? It's because these mistakes, although may seem obvious to us in hindsight now, and because we deal with this pretty steadily with a lot of clients, when you're living in it on the day-to-day, it's your emotions that are driving you to make these decisions. And trying to make a rational decision while thinking emotionally, good luck.
Yeah.
Good luck. And that's where we come in and kind of take the emotions out of the decisions entirely. We know what's best for you and for your family's future. And we've seen it enough times now where we can identify these three major issues and get you to avoid it as best as we can.
So let us know in the comments section. Are you doing things on your own? If you're brave enough to let us know that you're doing things on your own, let us know how you're doing. If you're not doing well, like John was saying, contact people like us. We're at arm's length. We won't be emotional about the portfolio. We'll do the right things for you. But that's our video for today. Again, if you do like our content, please subscribe to the YouTube channel or just give us a like. Until next time, I'm Carlo Cancino.
I'm John Iaconetti.
And this has been Ask TMFG.